There's been a lot of questions in the markets as to where we are going, and some suggestions that it's just a question of time before we see some big downside coming through for risk assets. Well, joining us now from a technical perspective is Ron William from RW Advisory. Ron, welcome. We've spoken a lot before about cycles, where the markets are going. And I know this is one of your theses, is that you've been looking at the timing of an opportunity to take the markets on the way down. And indeed, your latest papers talking about these dominoes, that are we now in a position where we're likely to see them fall? Explain more about what's going on in the context of these comments.
Well, certainly we're in history in the making, and our opening chart highlights the echo rhyme of bank failures and panics going over the last 100 years. And in fact, we've hit the 90-year anniversary of the 1933 event risk to the month of March that just passed. What's more interesting on that same opening picture is the extremes. And we can see here, based on bank failures, 1989 still wins out as the record, again, in terms of US bank failures. But the larger footprint, and this is the change in the historical rhyme, is in terms of total asset wipeout. The record there is 2008. And what's interesting now, so that's disproportionate number of banks that can still that are more leveraged, basically, in terms of liquidity, in terms of connectedness, and money that they're managing. What's interesting now is that 2023, with only just a handful of banks, we're actually at the record of 2008. And so that just gives the audience members just some context here on the banking crisis, whether this is a near miss or the eye of the storm ahead, and how it sits in history.
And of course, that's the big thing, isn't it? Here, this balancing of the risks from where we go from here. Let's take a look at the cycle risk. We've spoken about cycles before. I know you're a big proponent of looking at cycles. How does all this fit into the big picture?
So big picture, this comes as less of a surprise, because the composite cycle work that I've been following and developing for years does continue to signal risk ahead as part of a multi-year transition period. This is the same composite cycle that correctly predicted the 2020 shock. It didn't tell us there was going to be a pandemic, but it did say trouble ahead. And certainly we see that in figure 1 in terms of the sine wave curve, part of that cycle. That also coincides with the models of Benner and Gann. You can see there in figure 2. These are pioneers in the industry some time ago, highlighting that the stress points of 2023 this year and next year, 2024, as being key to watch. Now, what's interesting is if we look at related indicators, figure 3, top right, we can see that the cycle model from the Foundation Study of Cycles highlighting elevated volatility in the financial stress index in the second half of this year, if you're looking for more precision timing. And then, of course, last but not least, figure 4, bottom right, highlighting the leading economic sentiment indicators based on consumer confidence, warning of recession ahead. So even the Fed is now signaling mild recession. There's a big polarized debate as to whether it'll be mild, soft, or hard landing. Time will tell. But certainly these are extreme signals that we're getting right here and now in terms of the second half of this year and beyond.
So how does all this lay itself out in, let's say, the benchmark S&P 500? Because there's a little bit of a curling over here. And I know momentum indicators suggesting we've got some downside to come. Just explain more in the context of this benchmark index.
Yes, so it's the globally recognized and popular S&P 500 benchmark index, the best risk indicator that we have really in terms of market sentiment, which has just reversed short-term, having failed beneath that key resistance level at 4,200. Technicians will be using key levels as their areas for inflection moves such as this. Why it's relevant now is because it's potentially confirming a major reversal pattern in the mix, with a minimum price objective of 4,000 psychological to the downside, with another level at 3,800, which marks the March panic low. If you look at the inserts on the right, it also shows what used to be a price time divergence. So price was going up, but our timing cycles based on the FSC model was pointing down. Now that's realigned and reinforcing the negative seasonality sell in May pattern, literally in the first week as we start. And the options market data, if you look at the bottom right-hand chart, figure 3, also marking very important risk levels, the 4,200 level, which I mentioned, which is the prior peak area and just a key level that people have been watching, but also 3,800, which is the next one, the March panic low, where there's a lot of put positioning based on options market sentiment. So watch out for that ahead if and when we do roll lower into 4,000, 3,800 next, and that will be the next deciding point.
One of the things about the S&P 500, of course, it's changed its colours to some degree over the last 10 or 20 years ago. There's a lot more tech stocks in there now. Tech stocks have had a torrid time last year. To what degree are tech stocks going to be responsible for leading this market in that potentially downward direction? I mean, let's take some of the FANG stocks, for example, as we've been calling them over the years. Are they going to be the big reason for the sell-off?
Potentially, and certainly as they were leaders on the way up, they will likely be the same on the way down, high beta up, high beta down. Now, the upside everyone is aware of, most profited from that, but the party ended in 2022 when we had the inflation and rate shock, and of course that put a strong headwind on corporate profits and just general expansion in the business cycle, more specifically growth mid-cap tech stocks, which were overvalued and had multiples that were maybe a little bit priced to perfection or too far into the future. Right here and now, those companies remain strong, largely from a fundamental perspective, but there is a reassessment now on the pricing sentiment side, and that's what we're seeing on stocks like FANG. So the chart there is FANG, Facebook, Apple, Amazon, Netflix, Google, as part of the strongest mix of the mega cap growth names, hitting a price exhaustion point. We will likely get a rollover beneath the prior peak, which will give further pressure and a mean reversion to the long-term 200-day moving average. Highlight the fact that FANG stocks were up approximately 40% year to date, which is phenomenal, really. But just keep in mind that while that has been strong, it may no longer be viable, particularly if we get this rollover, as you just highlighted in the question. And the charts on the right just highlight a little bit more of the impact that a rollover would have. Figure 2, top right, highlights in red just how important this has been. So remember, the S&P 500, 500 stocks, and just a very small number of those, less than 10, is the red area, and that is ultimately driven by FANG, including Microsoft. And the gray area is showing the rest, 495 stocks in the S&P 500 as having more of a minimal impact. So sector rotation has been narrow, and it has primarily been tech. And if we do get a rollover in that will, of course, add further pressure to the downside. And keep in mind the earnings season that just passed, while that was in line with expectation and there were some surprises to the upside, quarter on quarter, the trend is down. And again, that's the pressure of the inflationary environment impacting cost and just general earnings projections. So that continues to add headwind to the FANG and tech complex. So tech remains strong, but it's more dispersed. Selectivity will be key, and certainly scaling back on some of those profits and being aware of some of the market internal pressures will be important.
But of course, we've got to return to the banking sector, haven't we? This has really been where many of the headlines have been. It's not big banks either, it has to be said. It's these smaller banks, isn't it? So let's ask the same question. To what degree will banks lead the drop, or the regional banks be responsible for the declines ahead if that's what we get?
Right now, the chart is suggesting further risk ahead across the board. If we look at regional banks, as you correctly highlight, that is where most of the pain trade is. And interestingly, the slide is still moving lower. So if we look at the SPDR ETF on regional banking, I think the code is KRE for those who want to follow it. That shows the big multi-year reversal pattern that actually foretold this risk ahead of time, later on, of course, confirmed after the March panic. And it now suggests that there is further downside as part of the price projections, but also if we just look at the extreme low there, a potential to revisit if and when things get worse. And let's keep in mind, we already have just had the latest headline failure from First Republic, with further echo events that have followed. So keep on watching those news headlines as the events develop. It doesn't seem to be the end of this yet, and as Larry Fink from BlackRock has recently said, it's too early to call the extent of this market debacle. So further risk and stress ahead, and not just in the banking sector. This will, of course, impact credit in general, and the rest of the economy as we progress in this year.
And of course, all this adds up, doesn't it, to the macro indicators and where they're going and how they're likely to impact on the markets. What's your assessment of the macro risks?
Yes, so the analysis is based on behavioral, technical, and macro filters. And so looking at the bigger picture macro, we see still a red alert situation where the yield curve, as a case in point, tried and tested indicator that many will be aware of, given that we've been in a yield inversion where the short outperforms the long end, suggesting late economic cycle and recession ahead. This is now at a 40-year wide, if you look at the 10 versus the 2-year, or even the 10-year versus the 3-month, which is even more sensitive and timely. Now, often they do offer, signal a medium-term signal to recessionary conditions. Can be anything from 6 months to 12 or even 18. We're at the back end of that signal, so it really is any month now as we go into the second half of this year. And what's interesting, if you look at the top chart, figure 2, there is a surge in short-term treasury bills in the 1-month time zone, really just giving this time clock into the next event risk post Fed policy decision just passed. Next on the calendar, of course, will be the US debt ceiling. And while that ceiling may or may not be lifted, the X date ahead is in early June. And certainly the market is looking like it's concerned about that and maybe other related risk. If we look at the Fed own model on recession, they have finally acknowledged that a recession, albeit mild, is expected, and that's based on their model there. You can see in the bottom left, figure 3, showing a 58% probability, which doesn't sound like much, but if you look at it in a historical basis, it's the highest since 1982. And if you then look at the last chart I've highlighted there in terms of credit default swap, so how much does it cost to insure US default, that is at a new record, surpassing the global financial crisis of 2008. So this isn't Armageddon, end of the world stuff, but it is suggesting that there is still risk ahead. Clearly, the United States will, I'm sure, have a backstop contingency plan of some sort, but volatility will still be an inevitable byproduct of all of these different signals that we're looking at.
This is interesting, isn't it? Because markets therefore seem to be mispricing expectations from what the Federal Reserve is going to do. We've just been hearing recently from the Fed chair talking about the chances of interest rate cuts this year. Well, none, according to that, but markets don't seem to be agreeing with him. What's the situation? How do you read that tension?
Well, this has been a tension point for over a year and a half now. The whole rate hike cycle was a big surprise to the market last year. And if we all recall, not only did we have this surprise rate hike, but it was a shock in terms of the rate of change and the number of back-to-back hikes that followed. And of course, it was this paradox of fighting the inflation genie at the expense of a slowdown in growth. And whichever side central banks around the world are on that paradox, right here and now, the market is more concerned about the slowdown in growth, the potential systemic risk that has resulted. And the old saying, the Fed will hike rates up until something breaks. And of course, a few things have already broken with more to follow. That seems to be where the market sentiment is repricing their expectations that the Fed will likely cut, not just pause, as Fed Powell just said, but actually cut in the second half of this year. His base case, of course, is only a pause with likely resumption higher ahead. So interestingly, we get a polarization here between what the market expects and what the Fed itself has said it will do. This is the implied overnight rate, suggesting that central bank policy's hand will be forced for a cut in September onwards. And again, let's look at the debt ceiling in June, how that resolves, and any other tail risk that may follow from the banking crisis or other, as to how that may impact central bank decision. Also look at the employment numbers. That'll be an important part of the late economic cycle signal, as adding further pressure to recessionary concerns, and ultimately whether that shifts policy or not. But certainly keeping an eye on markets will be key as the time prevails.
Yeah, look, Ron, it's a pleasure as ever. Thanks indeed for joining us. Your thoughts there on whether or not the dominoes are about to fall. Ron William from RW Advisory. And if you need some more advice on how to trade these markets, contact your IG client manager.